Assalamualaikum warahmatullahi wabarakatuh. Shalom, Om Swastiastu, Namo Buddhaya, Salam Kebajikan. Hello everyone. Today we will discuss about predictive approach, positive approach, income smoothing, and earning management. These are members of our group, among others, Muhammad Iqbal Wildan Irhamni, Evelyn Natania Akila, Alia Azahra Putri Dida, Indi Ara Bashira, and Muhammad Reza Pahlavi Anwar.
Okay, now I'm going to explain about the prediction of an economic event. So in accounting theory, this concept refers to the use of financial information to anticipate future outcomes of economic decisions or external events. This is grounded in the idea that accounting should not only record what has happened, but also help users foresee what may happen. For example, to predicting how a merger will affect future earnings and anticipating the financial impact of changes in interest rates or regulations. This predictive function is a key quality of useful information as stated in conceptual frameworks like those of the FASB and IASB. And next one is the objectives and the benefits. So the first one is about supports decision making. Accounting information helps stakeholders such as investors to decide whether to buy or sell shares, and creditors to assess the likelihood of loan repayment, and managers to plan strategies based on projected financial outcomes. And the goal is to make economic decisions made based on future expectation, not just past performance. And the number one is evaluates accounting methods. So accounting theories and methods are evaluated by their ability to generate information that aids in prediction. For example, accrual accounting is preferred over cash basis because it better reflects ongoing financial conditions and future cash flows. And the last one is develops accounting theory. So predictive capacity shapes theoretical development, such as positive accounting theory seeks to explain and predict accounting choices by firms, and theories are tested on how well they anticipate real-world behaviors, not just how logically they are structured. And then there's the examples of application. So the first one is time series analysis. So it involves examining historical data like revenue and net income to project future figures. And for example, like forecasting next year's sales based on a 5-year trend. And the next one is about event studies. So it used to assess how markets respond to specific events, like for example, examining stock price changes after an earnings announcement and studying how tax law changes impact firm valuation. This also links to the efficient market hypothesis, which assumes processes reflect all available information including predictive insights. And the last one is valuation models. So accounting data fits into models like discounted cash flow or DCF. So future cash flows estimated using historical data, and residual income model to predict firm value based on net income minus cost of capital. So these models are used by analyzed investors and auditors to predict financial health and estimate firm value.
Okay, the next material about market prediction, market-based research in accounting. The definition of market research prediction is market prediction. Predictions refers to the ability to forecast how the market will react to constant information, especially financial information disclosure by companies. And number two is importance of market-based research in accounting. This research helps accountants and managers in understanding how accounting information affect investment decision and valuation of companies by investors. And what is market-based research? Market-based research is an approach that uses market data and analysis to understand investor behavior and market reaction to certain information. Relationship between accounting information and market reactions. Accounting information such as financial statements can influence investor perceptions and in turn influence stock price and investment decision. In the research methodology is two. Number one is technique used in market research. In This is surface, secondary data analysis, statistical modeling, and the last two, data collection and analysis. And the factor of affecting market reaction is three: one, financial information; second, in economic events; and third, investor sentiment.
The positive approach in accounting theory, often associated with the early work of Watts and Zimmerman, differs fundamentally from the normative approach. Instead of focusing on how accounting practices should be conducted, the normative approach, the positive approach, seeks to understand, predict, and explain the accounting practices that actually occur in the real world. These are several key characteristics of the positive approach. First, the primary goal of this approach is to describe and explain why companies choose specific accounting method and how they respond to accounting standard. It seeks to answer the question, why do companies do what they do, in the context of financial reporting. Second, the positive approach heavily relies on the observation of empirical data and the statistical testing of hypotheses. The theory proposed are based on analysis of historical data and aim to identify significant patterns and relationships in accounting practices. Then, this approach often adopts an economic perspective in explaining company behavior related to accounting. It assumes that manager and often other stakeholders act rationally to maximize their own interests within the constraint of institutional and market forces. The positive approach emphasizes the economic consequences of accounting choices. The selection of accounting method is not considered merely a technical issue but has real impact on shareholder wealth, management compensation, and the company's relationship with external parties such as creditor and regulator. Then the research process in the positive approach involves developing hypotheses that can be tested empirically. These hypotheses are usually derived from basic assumptions about company behavior and the incentive faced by management. Then, there are main hypotheses in positive agency theory, which often forms the basis. Watt and Zimmerman 1986 identified three main hypotheses that are frequently used to explain accounting choices. First, bonus plan hypothesis. Managers with bonus plan based on accounting profit tend to choose accounting method that increase reported profit in the current period to maximize their bonuses. However, this hypothesis is more complex and depends on whether the company's profit is above or below cap and floor of the bonus plan. Second, debt covenant hypothesis. Companies with higher debt to equity ratio or thus approaching the limit in their debt covenant tend to choose accounting method that increase reported profit and reduce the likelihood of violating the debt covenant. Third, size hypothesis. Larger companies tend to be more likely to face greater political and regulatory pressure. In response, they may choose accounting method that reduce reported profit to lower their visibility and potential political costs. Then the research process in positive approach, researchers observe accounting practices that are interesting or raise questions. Based on assumption about company behavior and incentive, researchers develop theory and formulate testable hypotheses. Financial and non-financial data of company are collected to test the hypothesis. The data is analyzed using statistical method to determine if there is empirical support for the proposed hypothesis. The results of the testing are interpreted to draw conclusion about why company engage in specific accounting practices. Based on the research finding, the theory can be modified or further developed. Then, criticism of the positive approach. Despite making significant contribution to the understanding of accounting practices, the positive approach has also faced several criticisms. First, critics argue that this approach only explains what is without providing guidance on what should be. Second, the assumption that all management actions are based on rationality and maximizing self-interest may be too simplistic and does not always reflect reality. Third, statistical correlation do not always indicate cause and effect relationship. It is difficult to definitively prove that specific accounting choices are caused by specific incentive. 4. Researchers may unintentionally select data or analysis method that support their hypothesis.
Thank you, moderator. So I will presentation about hypothesis of income smoothing. So income smoothing is the deliberate reduction of fluctuation in report earnings to level considered normal by the company, achieved through good management practice and combined with accounting principle according to Riyahi and Belkhawi. It reflects management efforts to minimize abnormal variation in earning while adhering to permissible accounting standard. So this practice and this top profit information misleading may enhance external parties' predictability of future earning as their perception of management competence. It also risks incentivizing managerial competence based on manipulate financial outcomes. That's all material from me. I'll give it to the moderator.
Will explain earning management in the context of the accuracy of explaining paradigm accounting can be understood as manager effort in choosing and managing accounting policies to achieve certain goals which reflect the interaction between accounting theory and managerial practice in a complex business environment. Definition and concept earning management is the choice of accounting policy made by manager to influence financial statement to achieve certain goals such as increasing company value, meeting bonus target, or managing stakeholder perception. Then accuracy in explaining paradigm. Paradigm in accounting theory include the concept framework that underlies how accounting is understood and applied. Earning management is part of the paradigm because it describes the dynamic between positive accounting theory and real practice in the field. And then positive accounting theory and earning management. This theory emphasizes that earning management practice are a phenomenon that can be explained specifically and predictively, not just as ethical or unethical behavior. The role of corporate governance in earning management in the modern accounting paradigm. Corporate governance is an important variable that affects earning management practice. Effective independent commissioner and audit committees can reduce earning management opportunities, thereby increasing the transparency and accuracy of financial statement. Implication of the earning management paradigm. This paradigm embeds that earning management is not just a manipulation of number but also part of the managerial decision-making process influenced by various factors such as bonus motivation, debt agreement, and market pressure. Earning management in the context theory as a paradigm is phenomenon that describes how positive accounting theory explains earning management practice by manager. That's all for me. Thank you.
Okay, that's our explanation, and don't worry, this video is divided into two parts. For material that has not been explained, it will be delivered in part 2. Thank you for your attention. Wassalamualaikum warahmatullahi wabarakatuh.